For long-term goals such as retirement, you're probably putting away savings in a diversified portfolio of stock and bond funds. But how do you choose? You'll want funds that are easy to buy and sell, represent the market, and have low or preferably no fees. Index funds are a great choice. They're inexpensive and follow the market. One of the most popular is the S&P 500 Index Fund. The S&P 500 represents 500 large cap companies. These aren't necessarily the 500 largest. Instead, these companies need to meet the following criteria. Even if a company meets all the criteria, it still might not make the list. A secret committee ultimately decides. If a company is added, another needs to be kicked off. It's 500 companies after all. For example, in December of 2020, Tesla was famously added while another company was kicked off. This is an advantage for the long-term investor. You don't have to worry about missing out on a growing company, or worse, holding stock in a company that is long past its prime. The composition of the S&P 500 is continuously evolving. Although the S&P 500 represents 500 companies, it is weighted towards the biggest. At present, these are the top 10 companies in the S&P 500. You know most, if not all of them. These 10 companies are responsible for around 25 to 30% of the S&P 500. That's a huge chunk. So when one of these stocks move, the S&P 500 moves, and the entire market moves. If you choose to invest in the S&P 500, it shouldn't be your only fund. You'll want to mix it up with bond funds, perhaps international funds, or small and medium cap stock funds. But that's a subject for another video. The S&P 500 makes a good core holding. If you are investing within a qualified retirement plan, such as a 401k, you probably have limited choices. But the S&P 500 index or a quote-unquote large cap fund should be one of the choices. If, on the other hand, you are investing through a brokerage account or an IRA, you should have a broad selection to choose from. In fact, you may have too many choices. Index funds have very low fees. In the old days, it wasn't unusual for a fund to have fees of 1 to 2% or more. This would significantly cut into your return over time. Fortunately, those days are over. Many index funds are available for less than 0.05% in annual fees. Several have no fees. Here are some examples. But before we get into that, just a reminder, you should always do your own research, preferably with the guidance of a licensed financial planner. 3 well-known low-cost financial institutions are Fidelity, Schwab, and Vanguard. And no, at present I'm not affiliated with any of them, just a big fan. All 3 have a robust selection of both mutual funds and exchange-traded funds representing the S&P 500. At the top of the list is the Zero Large Cap Index Fund from Fidelity. Although not technically the S&P 500, the price tracks the same, probably because most of the stocks are identical, especially the big players. Why is this fund the top pick? Because the fees are, wait for it, 0. If you must have the S&P 500, Fidelity has one of those too, with an expense ratio of 0.015%. Schwab has their own S&P 500 index fund with an expense ratio of 0.02%. Rounding out the bunch is Vanguard's S&P 500 index fund with an expense ratio of 0.04%. You can't go wrong with any of these choices. In addition to traditional mutual funds, you may also invest in an exchange-traded fund or ETF. ETFs are like mutual funds. The biggest difference is that you can buy and sell them while the market is open, just like stock. SPY or SPY is one of the oldest ETFs, and most likely one you've heard of. But its net expense ratio is a tad high at 0.0945%. You can do better. Spider has another ETF, their portfolio S&P 500. That one is only 0.03%. Another big ETF player, iShares, has a core S&P 500 fund, also 0.03%. Not to be outdone, Vanguard's S&P 500 ETF also has a net expense ratio of 0.03%. If you prefer Schwab, they also have a large cap ETF with a 0.03% expense ratio. If your account is at Fidelity, you needn't bother with ETFs, just invest in their zero-fee large cap index mutual fund. 2 additional wildcards came up in the search results: SoFi Select 500 ETF and BNY Mellon US Large Cap Core. Both have a net expense ratio of 0. This discount may or may not last. To get the best deal, you may need your account at Fidelity to purchase Fidelity funds, Schwab for Schwab funds, and Vanguard for Vanguard funds, even though all 3 institutions sell each other's funds. Other ETFs, like iShares and SPDRs, should be available from any financial institution that buys and sells stock. There's quite a bit of overlap when it comes to fund availability. So if you're deciding where to start or roll over an IRA, for example, you may wish to do a bit of comparison shopping. Good luck! If you like this video, don't forget to like and subscribe. What other videos on personal finance would you like to see? Leave your suggestions in the comments below.